you guys talk about financial freedom all the time. Well, the management company literally is financially free because, I control the revenue to it.
Hello, everybody. It's Jake Stenziano, host of Wheelbarrow Profits Podcast, who my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy. Gino Barbo. Gino, how's it going?
Mr. Stenziano, we're talking dongles today. We're talking swords.
Keep it PG, man.
We're talking blue shirts. I mean, that's just the beginning. We're going to have an amazing show today because we've podcasted this guest a couple of years ago. A lot has changed. I know he's gotten probably much better than what he's been doing. He's out and he's got a beautiful background out there. So, Jake, let's introduce today's guest.
Absolutely. Today's guest is Ken McElroy, co-founder of the MC Companies and real estate advisor to Robert Kiyosaki. With over $1 billion in investments under management in real estate, Ken offers a unique perspective on how you will get the biggest return on your investments. He is also the author of the best-selling books, The ABCs of Real Estate Investing. Gino, I haven't read many real estate books, but I read that one. Also, The Advanced Guide to Real Estate Investing, The ABCs of Property Management, and most recently, I don't know if you got this one, book on entrepreneurship, The Sleeping Giant. So without further ado, Ken, welcome to the show.
Hey guys, thanks. Great to be on again. I haven't talked to you guys in a while. How you doing?
We're doing great.
Doing really good. Now, let's get it kicked off for the folks that haven't heard your story. Why don't you just give them a quick background on how you got into multifamily investing?
Yeah, well, I started through property management right out of college and, started managing properties while I was still finishing up. And that's how I learned about the business. And one day I was like, I'm on the wrong side of the desk here. When the owner would come in and collect the money. And so I started working for an investment firm out of Seattle, Washington, and then worked for him for about 10 years and then started buying and never looked back, man. I started with a 2-bedroom, 2-bath, used my own cash, quickly ran out after a few of those, and then started to learn how to syndicate. But I didn't know how to buy them. I knew how to manage them. I didn't know how to buy them, finance them. I didn't know much, but now we've got just under 10,000 apartments, 250 employees, a construction company, development company. So we've got about, I think close to 200 million under construction right now for new ground up construction apartments. So we're multifamily guys, and we also have self-storage and office, but primarily multifamily guys.
So, Ken, last time we spoke, I don't think you'd gotten into the development yet, correct? I mean, we talked a couple of years ago, and you had problems finding deals like we did, and I don't think you were pulling the trigger. You were underwriting a couple hundred deals, maybe one was working. And so what changed in the last couple of years for you to pivot?
Yeah, great question. Yeah, so, well, we've always chipped away at, we don't build for other people, so we only build for ourselves. And as you guys know, you don't really build when the, per door is, $40, $50, $60 a foot. Mm-hmm. And so what was happening is prices were going up, as you guys know, and rates were going down, and a lot of people were jumping in. So it was pushing the Class Bs and the Class As really expensive. So, we started seeing, an opportunity to start buying land and build for cheaper. So, Class A was trading at higher than we could build it, not a ton higher, but higher. And so we started snapping up land. And so we've always done it, but it's kind of a, when you got value add, you just got to stick to value add. Mm-hmm. And then all of a sudden value add gets to that point where it just isn't worth buying anymore because you're paying 3 caps, 4 caps. And so that's when we turned to land. And so we've been doing that for a couple of years now.
That is awesome, Jake. It's the 3 pillars of real estate. It's the market cycle, it's the debt, and it's the exit strategy, everybody. Write those 3 down again. What Ken just nailed upon is he understood the market cycle. It's at that point that you can't buy C properties and make sense. There's no value add. Those are distressed properties a few years ago, and that's where the value add was. And all of a sudden, wow, the light goes off. He's like, I'm not buying these properties, overpaying for them. So go ahead, Jake.
Yeah. So Ken, it's great that you're bringing this up, and the world works in funny ways because we're literally, going through the same thing, looking at these costs that we're seeing. We're seeing, 70s product getting 90 offers on it, and it's going for a price that we don't want to pay. So we're looking at actually starting to develop next year. Talk about your in-house team, because we're going to have probably an in-house GC. What are you doing for architecture? Are you subbing that? Are you subbing the GC? Give us an idea of what the team looks like internally.
It's a great question. Yeah. So So we develop our own and we're the GC. So there's two ways to do it. One way to do it is to find a really good GC that knows how to do multifamily.
Mm-hmm.
Now, there's a big difference between residential multifamily. As you guys know, that's obvious, but with a general contractor and the subcontractors, there's a massive difference. So one thing you guys might want to consider is getting a GC and partnering with them. So you're the construction manager, let them do all the stuff. Because,
that's exactly what we're looking at. Yeah.
Yep. Yeah. Perfect. Yeah. So it's a great way to start. And then hire your superintendents per job. So that's what we did. The architect and the design is very important. So what we decided to do, there's different, I've been through this before. There's different kinds of building products that you want to build. So you could do ultra class A plus, which everyone does. Or what we decided to do is what we call our A minus deals, which are just, they're straight stack units. So you build 1 bedrooms, 2 bedrooms, 3 bedrooms in sequence. So maybe 12 unit buildings or 14 unit buildings, and they're all 1 bedrooms or all 2 bedrooms. You can get really fancy and you can stack them all in there with hallways and garages and all that kind of stuff. And it just drives costs up. Mm-hmm. So the design itself is super important as you guys start building, because you can build it in Arizona. We can build it, say, 150 a foot, or you can build it 250 a foot. It just depends on the design. Mm-hmm. So and you're not going to get that much incremental rent for another 100,000 a square. So it's the design is very, very important. The architect is very, very important. But I'm happy to help you guys offline too on that as you guys navigate through.
Awesome.
We have 250 people on our team, and we're now cutting out dining rooms. We're now cutting out, we're now doing things that are kind of COVID. Mm-hmm. There's a lot of trends in the industry right now that are, we're starting to see the 2-story garden walk-up deals are really popular over obviously anything elevated. So it's been an interesting time.
Ken, I want to get back to when you said you knew how to manage them, but you didn't know how to buy them. Well, what's the difference? Because our 3-legged framework is buy right, manage right, and finance right. We teach a lot on the manage because we're vertically integrated. And I don't want to say the word gurus, but most teachers out there, just the shiny object. They teach you how to buy, they teach you how to raise capital. But then, oh my gosh, I have an asset. I need to manage this thing. You're great at managing. What was the difference between the manage element of the thought process and the buying thought process?
Well, great question. So, it's nothing you can read, as you guys know. It's like, you have to just fail. You have to try stuff. You have to try stuff and go, okay, that didn't really work, And so I think I probably went through the same cycle that a lot of people go through. If somebody's buying something and they're entrusting somebody with all this money, and you're actually physically buying something, you really need to have the best professional property management company that you could pick, and then learn from them first. Don't try to. It's not a lot of money management. In fact, my management company, it's break even at best. We make a little bit on it, and we manage just under 10,000 units. And because we're throwing pricing managers and advertising people, and all these, and we have customer service people, and so every time you get bigger and bigger and bigger, you just, in order to manage well, you just the overhead stacks up.
Quality control and systems. Yep, it just adds up.
Yeah. So what I did was, I was as a fee manager, I was able to learn from so many properties that I was managing. Literally, the hiring problems, the expense controls, the price increases and the resident retention and all the things and the locations and which ones were good ones and bad ones and advertising that worked and didn't work, and all that stuff calculates to real dollars. And so what happened was, I didn't really realize how much experience I had when I actually went out. So as you guys know, I was being hired for due diligence toward maybe probably in year 7, 8, 9 in my property management career. And so guys would come to me and they would go, hey, I want to buy this 200 unit building. What do you think? And I would go in and scour the heck out of it because I was trying to get the management contract. And so I would turn it over to them, and they would do it all, and then they'd make millions. And, I'd have this $3,000 or $4,000 a month management contract, that probably cost me $3,000 or $4,000 to run. So I was like, okay, this is it. And, the funny thing about property management is there's three things. One, you take over a building from an owner, and let's say, it doesn't, the performance is not better than when you got it. Well, you obviously get fired. So if you take it over and it stays the same, you obviously get fired because they want you to perform. If you take it over and you increase the value and then they sell it and you get fired. So the property management business is tough, man. And but having that experience enabled me to see deals because I could look at stuff that was, let's say, from a broker or a seller, and I could go, this really has a value add component because I had done that. There's a great way to save on expenses here because I had done that. Property tax savings or utility savings or whatever it might be, or and you could spot bad management. That's a great way to find real estate deals.
Renovation through operation. I'm sorry, valuation through operation, not renovation. That's the thing right now that we're really focusing on. So, Ken, I got to ask you a tough question. Was it your limiting belief of not going out and buying them yourself because you were just too comfortable managing them? I'm like, you know what? I don't want to take the risk of investors. I don't want to take the risk of buying these things because I'm comfortable making my $3 or $4 grand a month until it really hit you. Goes, damn, I'm losing an opportunity here.
100%. Yeah. So what happened was I was growing my management company, and I had offices in Seattle, Phoenix, and Las Vegas. So, I had a nice regional management company, and we were growing, and, I had accounting challenges and regional management challenges and all of those things that you would have as you're flying around managing these projects. And we had one client that had come out of Seattle, and he had taken a bunch of Microsoft money, guys that kind of started early in Microsoft, and they were just buying all kinds of stuff. And so he came to me one day and said, "Hey, I want to buy your management company." And so I and obviously entertained that thought, and I'm like, and so he showed me all the business plans and all the things that he was doing with the equity side. And I was like, man, this is awesome. But I didn't particularly want him as a partner, to be honest with you. So I told him no. And then he came in and tried to hire my CFO and my head of property management. He tried to basically took all my forms and he started his own management company. And we lost about a third of our business, essentially. And I was like, I don't want to go through that again. I want to be in a position where I manage my own stuff, and I don't want to have to be in a situation. It's a great learning lesson, life lesson. And, even though it was painful at the time, that really changed. Obviously, when you're ramped up and you lose a third of your income, and basically these management contracts are, 30 days. That's not a good position to be in. So I was like, okay, I'm going to be the general partner. I'm going to be the management on everything, and I'm going to control my income. So for me, my management company enables, it's financially free because the properties that we own, I'm the general partner on all of them. I pay myself. And so, we have, you guys talk about financial freedom all the time. Well, the management company literally is financially free because, I control the revenue to it.
So I have so many other questions bouncing around, but reasons reap rewards, everybody. Ken had a reason to do that. So when you have a reason out there, it'll give you the impetus to do it. So just look for reasons. Ken, what do you look for in a partner? I mean, that partner, obviously you had that gut feeling. You're like, this guy is working out.
He's right too.
Yeah. So what do you look for in a partner? I mean, we're talking even vendors. When you're talking about GCs, you're gonna marry these people. I mean, you could marry off one deal, but when you're getting into building and you're trying to hire people, what are you looking for in that partner or that vendor?
That's a great question. Yeah. Well, I think here's the thing, guys. I actually think the signs are rather obvious when you look back. You know what I mean? I have my own blinders on. I was like, okay, clear. That was clear. In any kind of relationship, you've obviously did a great job, finding a wife. And so
Julie was on a minute ago, folks. She was on before that.
Dude, it's like a broken clock. You're right twice a day. I'm right. I can be right twice. So I made one of them was like a great life decision. So,
Yeah. Well, it's actually very similar. I have a partner now, Ross McCallister. He's phenomenal. He loves to do the construction and the tax, which are two things that I don't particularly like, especially tax. I actually really enjoy the operations. I love going to properties, et cetera. So we have very different things that we like to do. That was really helpful. The other thing is we always think of our investor first, always. So any decision we're ever making, it's never about us or the company. So it's always about the investor. And so we were really aligned there. Obviously, he brought a lot to the table. He actually has a general contracting license. So that's super helpful. Even though we don't use it, it's good that he manages with it. And honestly, he's like my brother now. I mean, the character is so high on him. And, I trust him with, as you guys know, we now have close to $1 billion worth of holdings. And we have a lot of money flying around and all the time. And I just don't ever question it,
So Jake loves these kinds of questions, but you went from a 2-bedroom, 2-bath to scaling $1 billion, 250 employees. Give us some tips. We talk about people, systems, and culture, and it's easy, but how did you scale such a massive, you're in Seattle, Phoenix, Vegas. How did that start from a little 2-bedroom, 2-bath to where you are now?
Yeah, it does seem daunting, but it's every day. I just kind of focused on, I like you guys, I had a lot of short-term and long-term goals. And so they were in the beginning, it was all fee management based. And then it was, I just bought one, and then I bought two, and then I bought three, and then I learned how to do partnerships. And, and as you guys know, it just becomes easier the next time along. And then we started looking at markets. So in 2000 and early 2000s, when everything kind of crashed, I bought a 9,000 unit management company in Texas, and that put us, in those 5 markets. Well, there's more than 5, obviously, but Houston, Dallas, San Antonio, Austin, and Fort Worth. And so, we went into those markets on the fee side, but then I slowly got rid of all the fee and started buying. But I had the data, I had the operating expense information. So I went in, under the guise of a management company, looked at all their financials on the data, and then we started buying, based on that. And so that's how we grew. And each year, I'm not gonna lie, sometimes it was painful, and sometimes it was great. And the last few years have been great. You can fog a mirror and things go up. You know what I mean?
Did you buy any of the assets in that portfolio that you're managing?
I tried. It didn't work out. So we ended up. It was funny. Like, they had 9,000 units, and at the end of the day, I rated them red, yellow, green. So the green ones, I was like, okay, we'll keep these. The red ones had high AP. This was a time when people weren't paying their bills. It's kind of what we're heading into, probably in some respects. They weren't paying their bills. Their debt was too high. Their interest rates were too high. Whatever it was. And so we basically let all the red management accounts go. We tried to work with the yellows. That went okay, and we kept the greens, and then we just kind of started buying from there. But the best part for me, guys, was, as you know, it's a boots on the ground thing. So when you're trying to find something, let's say in Dallas, and I don't know anything about Dallas, you have people that who had like 100 employees or something. They're actually working every day there. They're managing properties. They have a lot of experience in Texas, and so we're weighing on them so I'll call them up and say, go check this property out. The rents are 800. Is that right or wrong? And so I'd have to be on a plane all the time. So it was really kind of a strategic move to be able to have intel on the ground and the financials from the management firm. And that worked out really well.
What markets are you currently looking at right now post-COVID?
So we're just focusing on Arizona at the moment. We haven't actually been a builder outside of Arizona before. And the truth is, we have 5 deals right now, right around 1,000 units under, in various stages. And there's plenty of work in, from Tucson and Phoenix and Scottsdale and Tempe and Mesa all the way up to Flagstaff for us. So, that's gonna keep us going for the next few years without having to jump on if you even want to jump on a plane,
So Ken, this is a tough question for us because we manage like you do. And every time you bring on a big deal, 150, 200 units that is sort of distressed, it sort of slows us down in the growth mode. How have you been able to overcome that? Because we're property managers, and I don't want to stress Jake out. Jake does the property management day to day. I can't bring on too many distressed deals. I mean, like, I don't want to have children and abandon the children. That's what the mantra seems like. People are just looking to buy deals, and they're not really focusing on the property management. How have you been able to handle both of those, where you're continuing to grow and also manage these deals?
Yeah, it's all about the team. So I got to the point where I completely understand that, Jake. I mean, it's, especially something that takes a lot of work. So what we do is we underwrite the deal so that it's funded to be turned around. So in other words, we don't put the stress on the management company. So for example, I bought a 680 unit in San Antonio. It was 50% vacant. You can imagine, right? So obviously no cash flow. So then when you take over a 300 or a 680 unit and you got 350 vacant, there were another 100 that had to go. So all of a sudden, the first 90 days, we had like 450 vacant. Well, so obviously a massive undertaking, a massive turnaround. We budgeted 2 years. We put some interest reserve up. We ended up hiring a team that was all funded through the syndication itself. In other words, it didn't hit ops. So we feel like you cannot burden ops. Ops is ops. The turnaround team is not included. And so we syndicate that piece. And so if it's $100,000 or $200,000 for 2 years, it's cheap, because what will happen is you'll have your maintenance guys that are turning units for the people that are in the property over here trying to, get units ready, on the distress side. So, and it just puts a tremendous amount of burden on the operations. And so we, through, trial and error and learning and failing and seeing things not hit up, not being able to turn units and turn stuff around. I totally understand it, but we just said, okay, listen, we have to separate them. We actually have a full renovation manager on staff now that manages our turns and has nothing to do with ops. And all their job is and we learned that through construction. Construction is construction, obviously, but then you turn it over to management. So you build a thing, you build a unit, you punch it, you get it all ready, and then you give it to management. So we go about it the exact same way. We say, okay, the renovations are over here, and when are they going to turn it over to the management company? And so the management company can run as they should. And then now you have the pressure on two buckets. You have the pressure on the ops, you have the pressure on the renovation side, and usually one's behind, or you know what I mean? But then you just manage two different things. It's funded through the syndication. It's not a lot of pressure on the cash flow side.
On that typical deal, would you refi that deal, or would you go to sell that deal?
Absolutely. No. We try not to sell. We actually sold, in our history, we're buying home guys. And so that property, the numbers, the bank owned it. It was 28 million note. We got it for 21. I put 7.5 in. So our basis was called 28. When we stabilized, it was 40. We put 30 on it and had 10 million in equity and paid all our investors back. And then that was, and then we've actually done it again. So we refinanced that twice. We still own it. Yeah, we still own it.
That's the payday.
So
So that's why we love
right.
Kenny McElroy. That's why we love him, because that is the strategy. That's why. So my question to you is, what mistakes do you see syndicators out there make? For me, it's like killing the golden goose. We've got two of these deals you're talking about. We've got a 140 unit deal, and we've got another smaller deal. Same thing, 2 years, but we didn't syndicate them. We bought them internally. So we don't want to kill the golden goose. We've cost segregated them. We're going to refinance these things out, pull all our capital, probably double it. Once it's stabilized with the new debt we're putting on it, 3% plus, it's almost free money. So it doesn't make sense for us to sell these things. But we're in the operations side of it also. What mistakes do you see syndicators making out there right now?
Great question. Well, as you guys know, you said it. There's 90 people chasing deals, and usually you're $1 million, $2 million, $3 million low on a lot of these.
You feel like a jerk put in the offers even.
Yeah.
You put this offer and it's like you're so far off. It's like, what the hell, right? So
I'll tell you the funniest story, actually. This is a great one. So Ross and I, we were looking at, we had 40 deals, and we looked at what we call our bottom 10, and I could say that now because we sold them, but we don't sell normally. But these were 10 deals that, after all the dust settles, you're like, okay, this is a tough market, or it's a rough location, or we've made, whatever it might be, or, like one of them was in Tulsa, Oklahoma, and oil, the oil prices have been kind of nailed, and we just weren't getting the rent growth, or whatever it was. We went through a whole list, and we said, let's see what these 10 are worth. So we listed them all through CBRE. They packaged them up. They went out a year and a half ago. We sold them all last year at a 4.2 cap. So I can assure you, we didn't have that kind of cash flow coming out of these things. And there's no way we could have gotten that kind of a cap rate. And it was way below what we paid. So here's the point. One of the deals that we were selling was in Houston, Texas. And we put all these in escrow through about 6 different buyers. And I actually got the package as to invest in it. So we had the buyer send me our deal in Houston to me, asking if I wanted to invest in it. So it was cool because here I was, the seller, and looking at it, the syndicated is the same deal that I'm selling. And so, as you would imagine, you open up I said it to Ross, I go, check this out. So, inside of there, what does it say? Management's horrible, which is my company. It's a value add, which, by the way, we tried. I mean, for 6 months before, we actually renovated units there. We tried to push them, you know what I mean? And we really tried to raise rents. We looked at all the operating expenses. We thought that the property taxes were going to get jacked over time there. So there were lots of reasons that we sold that property. Plus, it was thin. It was thin on the cash flow side with the debt that we had at the time. And I think we were like at a 3.8 at the time on our note. Anyway, so it had the same thing. It's like, this is a value add. This management company doesn't know what they're doing. It's the same story every time. Now, honest, I haven't checked to see if they've done it, but I can tell you that before we listed anything, we obviously, if there's any meat on the bone, we're keeping that deal. Well, we didn't think that there was, but the shtick, if you will, is the same every single time. Value add, bad management, room to lower expenses and room to raise rent. That's it, or put new debt on. So they did that. They bought it, and the future will tell, where that one goes. But I can tell you from my own personal experience, because we were the owners and we owned that thing for 6 or 7 years. It's a tough property to run and pretty new, in the mid 90s and just thin. So I think that's the issue. I think people, what they do is they stretch. And, I've been in the business 20 years. And the reason why our investors continue to come back to us is we've been super conservative and super, we try to show lower vacancy. We try to show minimal rent growth, and we really, really try to play out, on the value add side. We actually don't believe there's a lot of room on expense savings. I just don't, you think of everything that's fixed. You got taxes, insurance, utilities, you got your basic marketing costs and your payroll. What you can manage is kind of your maintenance costs, really. And your CapEx, so anyway, I think that just understanding how, really nailing the next 2 or 3 years is the most important thing that syndicators do. The other mistake I've seen is that they, they're chasing fees and they're putting their preferred returns too high. And, and then that kills, because, the cost of equity is real, a lot of people don't talk about it, but if you raise $10 million and you're paying 8%, it's a big number. You got an $800,000, $800,000 number to cover,
So what Ken is talking about, he's talking about pencil whipping a deal. Don't pencil whip a deal. Don't make the deal work. And we're all guilty of that. We love these deals. We love the way they look. Don't love the deal. Love the numbers. That's, I think, the big takeaway from that.
Actuals. Yeah.
But Ken, my son is 18 years old and he's starting to underwrite. And it's been a grueling experience for him because I love it. Because you try to help your kids out and he comes back and asks me questions. I'm like, no, you have to figure it out. And the machinations of going on. And it's pretty complicated because he's using our spreadsheets and all. Do you have any advice or tips for my son or anyone really wanting to learn how to underwrite and dive into those templates and say, wow, this is what you should be doing?
Yeah, I do. Great question. I actually have a 19-year-old doing the same thing, and my 22-year-old just did an internship in our investor relations
Isn't it
department.
painful to watch him like struggle? Because my son's a smart kid. I mean, he's going to Flagler freshman year of college this September. I think he's like most young kids. He just wants to know the answer and get scoot by. And like you have to dive in and you have to you feel the pain, because when you're intelligent, you can skate things sometimes. But I see the struggle, and he keeps coming back, and I keep saying, keep asking me the questions, because the better the questions you're asking me, the better the answers you're going to get. So that's the way I've been trying to propose.
Yeah. It's interesting. We've had a number of, folks in our firm that have had masters of finance and CFOs and, masters of accounting, and really smart folks. And, on a number of occasions, they follow their little system, and, I get it. And it's honestly, maybe it's 20% wrong. They get it there, but they don't understand the nuances of the management stuff. And so for me, I think real estate, as you guys know, real estate's very local. And so property taxes and insurance and utilities and even payroll can vary greatly from, market to market. And those are things, even with the national expense and income studies that you get from the National Multi-Housing Council or the National Apartment Association or whatever it is, what you see is the numbers all over the map. And even with vacancy statistics or occupancy statistics or rent growth statistics, people take that, they go, oh, this submarket is 3% rent growth, where, it might be flat, and what they do is they generalize, and they have to, but it's really a localized business. And so I think actually the secret sauce is in with the management themselves. So if your son can even just intern at a management company, a good one, for a short period of time, and understand the ops from the inside out, he needs to see a landscape bill come through on 3 or 4 projects and look at it and go, why are they so different? And he needs to see different priced water heaters, and he needs to see different price costs for, installation of carpet, because that all happens, with different vendors, and then you need to dig into that. And then, it's all kind of, day-to-day stuff.
It's funny you say that, because we're looking at the rents, and he's telling me on this deal that we're buying, it's a small deal, 48 units. And he's saying, hey, Dad, you're going to get about $600 in rents. And Jake is like, no, it's going to be $650 plus rubs. So you're so right. You can look at apartments.com. You can look at all the locals, but we know the market. I mean, that's what it is. So that's an excellent piece of advice. Get out there and start jumping into it, and start, especially if you're young. Yeah, it's a great tip. I love that.
It's localized. Yeah. That's actually the beauty of it, guys. I think. I mean, you guys can find a square block that's on fire, and and just a few miles somewhere else, which might be in the same submarket, might not be. And that's the beauty of real estate. That's why there's deals everywhere.
Ken, why did you write these books? I mean, you're such a busy person. I mean, you've got thousands of units, hundreds of employees. How did you take the time out to write the books, and why did you write them?
My crazy friend Robert Kiyosaki asked me to. So I was syndicating. I met with Kim and Robert, who happened to be in Phoenix, which is where I'm from. And he had just written Rich Dad Poor Dad, and I went and met him, and I really enjoyed that book. And he became an investor. And after about a year or two, he started asking me to go to some of his stuff. And so I was already living it and doing it. And I realized how many folks, don't really have financial education. And so I embarked on that, and I did. And it's, I donate 100% of the revenues for all the books and anything that I do to charity. And so it's for me, it's, because we're all busy. I was like, well, if I'm really going to do something, I might as well give back, through what I'm doing, as opposed to, trying to do something that I don't really fully understand. And so that is, for me, it's been a great platform.
Wow. let's dive into the books. I mean, you talk about property management and real estate investing. Which one did you write first? Did you write the ABCs of property management first?
No, I wrote the advanced guide or the ABCs of real estate investing first, which
Okay.
and then from there, people are like, okay, we need to learn about IRRs and ROIs, which I intentionally didn't put in the first one. So that's when I wrote the advanced guide.
I got you. Okay.
And then I was like, well, people are like, hey, we need some property management, which actually I'm in the process of redoing right now with my management company, and just updating it. And so that was the third one. And so those have been a pretty good little trio, pretty consistent. And it's been really, really fun.
The ABCs of real estate, for everybody out there, that's the first book that you really need to read, because it was one of those first books. It's simple, it's easy to understand. It talks about due diligence, it talks about value add investing. It makes the concept so easy. You don't need to learn about IRR yet. You just need to learn how to buy these little deals, and that book will definitely point you into doing that. So I highly recommend picking up those books. If it's 100% going to charity, buy 2 of them then. That's what I say. So buy as many as possible. Before we get into the short answers, Ken, where do you see the market going? Because, I mean, we were on with another multifamily investor, had thousands of units yesterday, and he's talking that multifamily is going to be okay. They're going to survive the cycle. He's worried about some other spaces, but he's saying multifamily, he sees cap rates actually compressing. He's from Austin, Texas. So he's talking about cap rates compressing even more. So what are your thoughts?
Well, I think it's going to be market by market. So like always, like you guys talk a lot about, multifamily is going to take it in the chin a little bit here, but the demand is still there long term. So, we're going to go into a weird time where there are tenants that aren't paying, and we have these eviction laws all over the place, different in a lot of different states, and forbearance and all these things happening right now as a result of a lot of that. So if you are a syndicator and you said, hey, I'm going to get $200 more in rent in Austin, Texas next year, I think you're wrong. So, now, could you get there at some point? Yeah, of course. There's still a lot of jobs there, but, we're going to get these temporary hits all over the place. Seattle, San Francisco, Chicago, New York, LA, the people are flying out of those markets right now. And, so those markets are going to get pounded. Also, employment's moving all over. So, I just did during this pandemic, I started this YouTube channel, and
which is awesome, by the way. Everyone's got to check it out. Seriously, awesome
Thank
job,
you.
bro. Great videos.
It's been fun. I'm home, right? So I'm like,
gotta do something.
I don't have the time. So it's been great. So anyway, so I've been kind of studying like what's going on with these businesses, and like markets, like Google, Facebook, Twitter, which are the only reason I'm using those is because they're household names. They're like, hey, you don't have to come back, right? So these are massive companies basically telling their employees, you don't have to come back. So if you live in San Francisco and you're paying $3,000 a month or $4,000 a month for rent, you can move an hour and pay $1,500. You're going to do that. And so I think, if you have a multifamily building near, Twitter, let's say, just, I don't know how it will do, but it stands to reason that a lot of people are going to be moving to what I would call affordable markets, and if they can work remotely. And so I think you're going to start to see some movement. Well, we're already seeing it. I'm in a small town in Idaho called Coeur d'Alene that is only 45,000 people, and it's on fire because people are moving out of Seattle. They're coming up from California. It's San Francisco, LA, San Jose. And so people are moving out of markets and out of areas that, not to be political, but, are blue, and there's a lot of potential homelessness, or property taxes are high, or, I don't know if you saw in Nashville, Texas, the real estate taxes they passed, they went up 34%.
Yeah.
And
wow.
Yeah, and that's within the last 30 days.
Well,
So
here's the thing. It's not even being political. Nobody, the average American doesn't want to be living amongst riots, and they want their family and themselves to be safe. And so, and the same thing, if the people are going to go, so at the end of the day, multifamily is people and jobs. That's the customer. That's where we're going, right? So I think if these people are exiting, the places that are going to do good, the markets are the ones that are going to be receiving, and the markets that are going to suffer, the ones that are declining. So I think it's pretty,
I completely agree with you.
Yeah.
Yep. I mean, you think about real estate exists for people, not the other way around. So wherever they are, there's going to be supply and demand issues. And so the key is, as Gretzky says, skate to where the puck's going, not to where it is. Yeah. And so if you kind of know that, if you can kind of figure that out, these migration patterns, I've been talking a lot about this. I haven't seen any results yet for 2020. You can go online and look at North American van lines or Ryder trucks or U-Haul or out-of-state driver's licenses and kind of see where people went in 2019. What states were getting people in and what states were getting people out. But it's going to be fascinating to see what's really happened. I can't wait for that data to come out, because wherever they're going, which is, as you know, we talked a little bit before, Florida, people are going to Florida from the Northeast. There are areas in Florida that are booming. There are areas in the Southwest that are booming, because you can buy a home in Arizona for $300,000, a nice home, brand new. So there are things happening right now, and people are moving around looking for affordability and the low taxes, I think, and they're trying to hunker down because they're uncertain about their income, in the next few years.
So guys, before we go to the short break, I just wanted to say that I am a genius because I saw this 3 years ago. So I left New York 3 years ago, just saying, and I got to Florida 3 years ago. So I saw this whole thing coming. I couldn't be lucky. I was the luckiest guy on the planet. I just said to my wife, actually, getting back to the wife, she said, you know what, if you want to do it, you got to do it. You got to leave the restaurant. You got to go into real estate full time. And I was going to do what Ken says. I was going to hunker down in my backyard here in Jacksonville. And I wasn't smart enough to see the demographics coming. There was 65 a door 3 years ago. And everyone's telling me I'm crazy to buy in this market. And now looking back, it was stupid not to buy it, but you listen to experts, but you just don't know, because Jacksonville is a sleepy town. But as you see the demographics, everybody's coming down here, and they're continuing to come down. So if you see somewhere where you want to move to and make it your backyard, I would 100% say get on board, go to where you want to go, and hunker down and make it your backyard.
Yeah, and don't miss what Ken said either, because these states that are losing population and losing jobs, what's going to happen? Taxes are going to go up, and the states that are receiving all this are probably going to remain more constant. So that's going to be a big impact when you talk about multifamily valuations. Like you said, with that 30% increase in the property taxes, that's going to hurt owners. So
love that.
Yeah, and rent control.
Exactly.
That's coming out. I mean, we just saw Oregon, the whole state passed rent control right before COVID. I'm like, oh my gosh. So property taxes are going. They're saying, no, we're gonna cap your income, and we're gonna jack your expenses.
No thanks.
I said, who's going to invest in Oregon?
Yeah, no doubt. All right, guys, let's take a quick time out to hear from our sponsor.
Are you looking for ways to improve your life?
Here at Jake and Gino, our mission is to empower students through financial education and the vehicle of multifamily investing.
Yes, Jake. We agree that a person with financial intelligence can change the world for the better.
We've created our proprietary 3-step framework, buy right, manage right, and finance right, that we teach to our community. This framework, along with education, our one-on-one mentorship, on-site boot camps, and the amazing community, has propelled our students to massive success.
We've all been there. We've had so many students that have been able to shift their mindset, overcome limiting beliefs, and set a clear path to achieve their goals. Whether you're currently fixing and flipping, wholesaling, or buying single-family rentals, and you know that multifamily investing is the right vehicle for you, I encourage you to visit jakeandgino.com/apply to schedule your complimentary consultation with our team. And I want to let you know this isn't a high-pressure sales call. It's really just a discovery call to get to know each other better and see if we're a good fit for working together. And if for any reason we're not a good fit, our team has tons of resources we will share with you to help you along your journey.
If you're ready to stop spinning your wheels, go to jakeandgino.com/apply and schedule your call now. All right, we're back. A few things on the personal success side, habits and whatnot. Ken, what is your best habit for success?
Hire the right person, hire the right people. That's by far it. You know, I years ago, I'm in a group called YPO and
Yep.
Young Presidents Organization. And we have, you know, there's a number of resources. I highly recommend that. First I was in EO years ago. And then I graduated to YPO when my company got bigger. And there was a speaker, gosh, it would have been 15 years ago, that basically said, hire for attitude. You know, don't worry about don't worry about their experience. And I'm telling you, that's all I've done. You know, you can tell, you know, when a waiter walks up to your table, you know what I mean? They have a good attitude or a bad attitude. Same with an employee. So I didn't ever, it wasn't a big deal to me if they didn't have a lot of experience, because a person with a good attitude always would come and say, okay, what can I do now? I just finished that. And what can I learn? You know, their minds were open.
Versus digging their heels in and they don't want to do it, or I'm too busy, or I got too much work coming at me. Can someone else? So that's right. I think that's everything, man. That's
that was it. That was, and same thing with partnerships and joint ventures and contractors, and you know what I mean? And all the way down the line. So that's probably been it for me.
Attitude is everything. I love that. What's a tip for folks starting to scale their property management business?
I think that, you know, the good management folks are not on the market. So they're working somewhere, you know. And so for us, you know, downturns like this are an opportunity to find good folks, because good folks are at places for 10 years, 20 years, they don't move. And so the ones that are bouncing around there's a reason that they're bouncing around. And so, you know, what I've done is, you know, I target people and I go get them, and, you know, one way or another. And I'm looking for people in my organization, as opposed to waiting to see when there's an opening and putting out an ad and interviewing 30 or 40 people and then getting down to 3 and then picking one. And, you know, I've always found that, and you can look at their history, but normally in property management, there's a very few that I think are amazing, and you got to find them and go get them and bring them in and sell them on the vision of your organization.
Think about what Ken's doing. When there's no deals, he goes out and develops them. And when there's the employee base is hot, he's going out and he's developing his people from within too, I'm sure. So it's very similar there. How about a good book recommendation?
Well, I think the Chris Voss, Never Split the Difference. That book, in my opinion, you know, it's interesting. We study books. We do book studies with Robert and Kim Kiyosaki and the advisors. And we actually brought Chris in via Zoom. And that book has some techniques. He's an FBI hostage negotiator. And there are some techniques in there that I now use that are just beyond belief. And basically the premise is, let's say you have a deal. Let's say you're buying a building, because this happened, and we were buying a building in Austin, and it needed new roofs. And the roof, we got bids on the roofs, and there were 400. And the seller said, hey, why don't we just split the difference? You know what I mean? And so you're like, okay, 200 next, you know, you move to the next thing. Well, obviously we just lost 200 grand, you know what I mean? And so, you know, what we should have done was say, no, the roofs are 400. And, you know, unless you can tell me how we can do roofs for 2, you know, so there's some
in
things
your
in
late night
book.
DJ voice, right?
Yeah, exactly right. Yeah. So I love that book.
So here's what you do. Hey, Mr. Seller, I know you think I'm being a cheap bastard. Acquisition audit, right? Classic Chris Voss.
Yeah.
But how can we make this work? How can we work together to get to the finish line? Because we can't just come out of pocket for an extra $200,000. What do you think we can do? That's like classic Chris Voss. We've had him.
How do you want? Yeah. How am I supposed to do that?
Yeah. I love that. We love him. He's fantastic. No, I love that book.
Yeah.
So. All right. What is the best way? You know, I know you're syndicating deals, raising money. What's the best way for folks to get a hold of you?
So if they're interested in investing, it's MC Companies, so mccompanies.com, and then through kenmcelroy.com. Like you guys, we have a ton of videos and a ton of stuff that we're doing, and of course we got a link for you guys, you know, the / Jake and Gino, for,
So
a
what is that
discount.
link? What's that link?
It's it's kenmcroy.com/Jake and Gino /. And we have a monthly sign up where they get videos and they get forms and they get all this stuff that we do. Plus I do a Facebook Live every week. And, there's forums and mentorships and all that kind of stuff up inside of there. So,
and the YouTube is just Ken McElroy.
Yes, Ken McElroy. Yeah, you got
Very
it.
cool. Very cool. Gino, man, this is awesome. Loving hearing this.
I'm going to try to recap this Ken's amazing journey, right? It's from when he got out of college. Picture this, everybody. Ken's a young guy. He's trying to get his way through college. He's property managing. And when I read his books, I know there's a lot of horror stories in there. He one day sees that the owner is the one making the money. What's going on here? Why is he getting paid and I'm not getting paid?
I'm doing all the work.
Goes to Seattle, Washington for 10 years. Starts working there. He buys his first 2-bed, 2-bath. And I think the rest is history, Jake. I mean, goes to acquires 250 employees, $1 billion in assets under management. On the way to the journey, he meets Kim Kiyosaki and Robert. He starts writing books for them. And that's the amazing thing about Ken, giving 100% of his royalties
for
earnings
charity.
Away to charity, which is just awesome. I mean, and for somebody being super busy and for having 250 employees, everybody, and managing multiple places and the ability to do that, take time out from that, take time away from his busy family. He's got 2 kids. They're both working in the business right now. It's something that I want to aspire to. I want my children to do that. There's so many good things in this podcast, right? It's just so many amazing golden nuggets in this podcast. I'm telling you one more time, you need to go buy the books. If you're serious about getting into multifamily real estate, you need to go purchase the books and start reading it. Start following his YouTube channel. Click on our link down below. Take a look at the other resources that he has because he's a wealth of knowledge. And I've just been, for us, it's been a great mentor for us.
Gino, it's because the one thing that he could control, which is what? The attitude, baby. He was in control of the attitude and had a positive. No, I'm serious. Like no shit, right? He had a great attitude, and that's why he's been growing. So.
And Jake, another thing, Ken could have stayed in his comfort zone and said, you know what, this multifamily thing sucks. Nothing's working. I'm underwriting 300 deals. But he said, how can I make it better?
They're beating me up on my fees, and they're trying to steal my deals from me. Shit.
Right? I mean, I'm sure he's got punched in the face like Mike Tyson says, but he said, just another one of those. He said, let me figure this thing out. And that's the amazing testament to him. He's always willing to grow. He's got the growth mindset. He's willing to take a look at stuff and say, you know what, I just need to work harder and I need to figure it out because I've been around a lot. And how do I get in this multifamily deal? These prices are crazy. Oh, well, I'll start a development company. I don't know anything about that, but I'll hire the right people and I'm not going to be cheap because if it makes me money, it costs me nothing at the end of the day. Right, Jake? So that's the true testament to an awesome entrepreneur.
Ken, awesome. Loved it. Thank you so much for coming on.
Thanks, Ken.
Great. Love you guys. Keep it up. Keep educating everybody. You guys are awesome. Thank you.
Thank you.
Thanks, Ken.